Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you're really well. Sorry for not being here last week. As mentioned, I was off sunning myself for a week in Kefalonia, which was really nice actually. And it sounds like I missed a fairly interesting week in terms of market movements. We had another surge in swap rates, which led to another kind of wave of lenders repricing. So all fun and games, more of the same. But actually, in terms of this week, it looks like things are going to be on a slightly better footing. So what we're going to be covering off this week is we're going to be talking about interest rates, we're going to be talking about the inflation news. I've also got some information on the property market, rental hotspots, and finally some information on landlord plans in terms of buying or selling over the next 12 months. So loads of really interesting stuff to cover off this week. Okay, now it is currently Wednesday morning at 7:28. I have been waiting for the inflation figures to come through before I did this video because they're so important to us at the moment. And actually what came through was relatively positive. So I don't want to sort of make out like it's all wonderful news, but it's definitely good news. So essentially what's happened is that inflation has dropped down in June to 7.9%, and that's down from 8.7% in May. Core inflation, which is kind of more of the big one as it were, has also dropped down to 6.9%. It was at 7.1% in May, so a small reduction there. The 7.1% figure we had in May was a 30-year high. So actually, and it went up. So that's also a really key thing just to kind of keep in mind. So the May figure was higher than the April figure, which really kind of set the cat amongst the pigeons. So a reduction this month to 6.9% is really encouraging. Now, in terms of the kind of what's going on behind the scenes, so there had been an expectation that sort of broader inflation, which has come in at 7.9%, it was forecast to be at 8.2%, so it's come down quicker than people had predicted, so that's really good. And the main contributor to this was the falling prices in motor fuel, so really good news there. Now, in terms of what this is going to mean for the market and interest rates going forward, so as I mentioned a few moments ago, last week was quite an interesting week in terms of swap rates. They bubbled right up again, so 5-year swaps went over 5%. As of 10:30 last night, and that's the most up-to-date figures I can get for you, 5-year swaps were at 4.864. So they have come down a bit before the inflation figures have come out, and that's really in reaction to the news in the US about their inflation. They're doing incredibly well. They're at like 3%, and the Fed sort of dumbing down their plans to increase interest rates there. So where we are with swap rates at the moment, so this might change again today on the back of the inflation news, and I'm sorry that I can't be more up to date, but there's a timing issue here. So 2-year swap rates are at 5.664. 1 month ago they're at 5.557. 5-year swap rates 4.864. 1 month ago they're at 4.926. So actually things have come down ever so slightly, but it is so volatile at the moment. One bit of news and it all changes again. So hopefully we're on a downward trajectory now. But you know, let's just keep our fingers crossed, I think, at the moment. Now, in terms of how we are expecting the inflation news to impact things, so obviously the Bank of England are going to be feeling good about the inflation news. I'm sure they're going to be sort of commending themselves that the measures they're taking with increasing base rate is starting to filter through. How appropriate that is or not, I think depends on which side of the fence you sit on in terms of how much increasing interest rates is really going to change the dial in terms of inflation at the moment. But the actual kind of school of thought is that maybe the base rate increase that we will see next will be just 0.25%. So you will remember that we most recently had an increase of 0.5%. What we're thinking now is that 0.25% is going to be the next increase. And then hopefully if inflation rates do continue to fall, then actually it won't go any higher. In terms of how we're expecting the capital markets to react to this news and therefore what fixed rates are going to be doing. So look, there's a couple of things at play here. So first of all, falling inflation is going to be really good. So what we will see, hopefully, if we continue in this vein, is swap rates to ease down. Now, the other thing that's happened is that lenders have been pricing in additional margins essentially on their pricing. So what we've been seeing is that when lenders' margins are really skinny, the minute their cost of funds for swap rates move, they're having to reprice because they're having to keep up with this very relentless series of changes on the capital markets. Now, what lenders have done more recently is say that we can't keep pulling rates every 5 minutes. It's not good for us, it's really bad for borrowers, and it's not great for mortgage brokers either. So what they've been doing is essentially building in a sort of extra margin to give themselves some wiggle room to allow for the volatility in the markets. So what we're expecting to see is that actually if things kind of really settle down, then actually lenders should be in a position where they might be able to sort of take off some of that margin and bring their pricing down a little bit. So I think it is a little bit of a watch and see week this week, but actually in the round, I think it's really positive news. I don't want to sort of over egg the inflation figures. It's great that it's come down. It's still really high. But actually, you know, I think at the moment we're all very glad for any sort of positive news. Now, in terms of where we are with mortgage interest rates, so look, you know, again, I'm not going to sort of reel through who's been doing what in terms of repricing, the consensus or the general things that everyone's been putting their rates up. So this is how it shakes out in real terms. So personal borrowing on a straightforward property, your 2-year fixed rates from 4.69 with a 7% arrangement fee, or 5.48 with a more reasonable sort of £4,000 fee. 5-year fixed rates from 5.15 with a 7% fee again, or 5.29 with a £4,000 fee. Discounted rates from 5.09%. Limited companies, HMOs, multi-unit, specialist lending. So same thing again, so 2-year fixed rates from 4.69 with a 7% fee, or 6.28 with a flat fee of 999. 5-year fixed rates from 5.15 with a 7% fee, or 5.75% with a £4,000 fee, and discounted rates from 5.01%. So, you know, the market isn't any of the stuff that we're sort of talking about in terms of movements we might see going forwards. It's very much going forwards, not reflected in the pricing that's available as of today. Now, there has been actually one nice bit of news which I'm very, very happy to share with you. And I've known about this for a few weeks, but it's been under embargo. But it's really good just to come to you with something positive at the moment. So we've seen the Leeds Building Society enter the limited company buy-to-let space, which is really fantastic news. Now, the offering that they've brought to the table is what I would call very vanilla. So they're a buy-to-let lender doing a bit of limited company lending rather than one of their sort of specialist lenders who is all guns blazing. So to kind of go through their offering just for a moment. So first of all, their rates are from 6.4%. So kind of, you know, pretty average at the moment. Now, things they can do, so they can do consumer buy-to-lets. So that is where you are, so with limited companies, it's slightly different. So consumer buy-to-let is essentially the definition of where someone looks to put a buy-to-let mortgage on a property where the sole intention when they acquired the property was not to rent it out. So my home that I want to rent out now, I've inherited a property, that kind of stuff. Now, some lenders do not kind of differentiate between personal ownership and limited company ownership. So what they would say is, if, for example, my home that I live in, I wanted to rent it out and move it into my limited company, sell it into my limited company, they wouldn't lend against that because they would still see this as consumer lending. Whereas some lenders actually sort of say, well, no, because you are a legal entity and a limited company is a legal entity, two separate things. So if you want to move it into the limited company, we don't see that as consumer. But the good news is that Leeds can do consumer lending, so they would be in this situation able to assist. Now, they can also lend to first-time landlords. There's no minimum income requirement. There's no maximum age. They can consider ex-local authority flats and those which are over commercial, and they can consider flying freeholds where the footprint can be, and the flying element of the footprint can be no more than 15%. And actually, they're very good at shorter leaseholds, so minimum years on application is 51 years. You can have a maximum of 10 buy-to-lets in the background and a maximum of 4 mortgages with the Leeds Building Society. So it is quite a vanilla offering, but actually I think at the moment it's really wonderful to see lenders re-looking at things which for years they've been saying, no, we're not going to go into that space. We don't really think it's necessary. It's great to see that they're really revisiting things and looking to see how they can shape their offering. And actually, to be quite frank about it, the more lenders that are playing in the more specialist end of the market, the greater the competition, and that will really help us with pricing once we kind of get through this current phase of the very, very high costs on the capital markets. Okay, now it's always interesting to hear what your landlord peers are thinking about doing over the coming months and what their strategy is. So when Landbay released a survey that they had done on a big group of landlords, it made some really interesting reading that I wanted to share with you. So basically, the question to landlords was, are you planning on buying more property in the coming 12 months? And of the respondents, 41% have said that yes, they are actually planning to invest. Now that in itself is quite a high number, I think, and probably more than I would be expecting to hear. So what was more interesting actually than that was the reason for considering buying. So 35% of those respondents have said that their main driver for acquiring more buy-to-let property is the demand from tenants. Tenant demand is increasing and also higher yields. Now, conversely to that, the number of respondents who have said their motivation for buying more property is falling house prices has dropped. So in the previous quarter, 54% of people who are talking about buying in the next 12 months said their reason for doing so would be falling house prices. And this has dropped to now 33%. So I think really what we can sort of derive from that is that actually landlords are not seeing house prices fall as quickly as they thought they would. But what we are seeing is rents continuing to increase and tenant demand continuing to increase. Now, Paul Brett, who is Land-Based Managing Director, has commented that once again, high tenant demand serves as a key driver for landlords to consider expanding their property portfolio. And while house prices have remained more robust than some landlords previously predicted, high rental yields are clearly still tempting some to explore the sales market. So there you go. If you want to know what your landlord peers are doing and what their plans are, that might prove rather helpful. Okay, the market is literally awash with house price data at the moment, isn't it? And I always think it's really confusing because there's asking prices and then there's sold prices. Personally, I put more stock on the sold prices because, I mean, anyone can ask any price for a property, can't they? It's how much anyone's actually prepared to pay for it, which is kind of the key figure. But an interesting piece of commentary nonetheless. So the average price of property coming to the market, so this is the listing prices now, fell by £905 to £371,907 this month, with new sellers tempering their price expectations as a result of recent base rate hikes by the Bank of England, as well as the increasing buyer affordability constraints. And this is according to Rightmove. So despite this decrease, Rightmove have noticed that price trends have proved more resilient than many expected during the first half of the year, with average asking prices now 2.6% higher than they were in January. Tim Bannister, who's the Director of Property Science at Rightmove, has pointed out that the brakes on the economy being applied by the Bank of England are now beginning to really bite in the housing market. So again, I think this kind of re-echoes back to what we were just saying with the land-based results. The housing market has actually performed better than people have predicted, but we're still in a very kind of rocky period where we're seeing things come down. So I think it's coming down slower than people thought, but it is still going down nonetheless. Rental hotspots. I just find these really interesting. So there's been a report that's been released by a company called Barrows and Forrester, who are a letting agent. And so they've just talked about their kind of view on the market and what they're seeing across the UK. So in terms of the hottest spots in England's rental market, Dorset tops the table with current rental demand sitting at 59.3%. In West Sussex, demand measures 58.1%, and tenant appetites are also strong in Rutland, Somerset and Wiltshire, which are all over the 50% mark. Now, the coldest spots for rental demand are Leicestershire, Merseyside and Nottinghamshire, which are all at 25% or less. In terms of quarterly growth, the Midlands is leading the way, the biggest increase being recorded in Herefordshire, followed by the West Midlands, Tyne and Wear and Northumberland. Now, they've also said that the local markets to have seen the biggest annual growth is Rutland, where rental demand is up 7.8% compared to this time last year, and the largest annual drops in demand have been recorded in the city of Bristol, Warwickshire and Nottinghamshire. Now, the chap who is the managing director of this company, James Forrester, has commented, and this is the bit that I always find really interesting, the commentary that goes around the data. Top-line demand for rental homes has remained largely static during the second quarter of this year, and this suggests that many tenants are sitting tight during times of economic uncertainty. And I think that's very true. So when we're seeing data in terms of how long tenants are now staying in a property, this has really been drawn right out as people, I don't know if it's that they don't want to move. I think it's actually that a lot of tenants just can't move because there's actually nowhere for them to move to, but actually still tenants are staying put for much longer. Now, that said, the market is generally in a state of limbo during this time of year, as many tenants have already made their move, whether it be for education or work purposes. There remains, however, a strong level of demand in many areas, and this is encouraging news for the nation's landlords. While the success of a buy-to-let investment may be primarily focused on the yield available, it's also about finding consistency of tenants and avoiding void periods, which, as landlords we all know, there is nothing more soul-destroying apart from having a non-paying tenant who trashes your house than having a house just sitting empty. So that's really, really encouraging reading for us there. So that's everything for this week. It's actually a more positive week than we've been sort of delivering more recently. So that's really encouraging. It really be very, very interesting to see what happens over the next few weeks in terms of pricing. Like I said, we are very, very hopeful that because of the inflation news here and also in the US, that the markets will really calm, and actually we might see things sort of settle down a bit. Now, when I say settle down, what I don't mean is swap rates back down to 2% or something like that, but what we should see is a slight easing, and that combined with the additional margins that some lenders have built into pricing means that we may see some fixed rates start to ease down ever so slightly. Now, the advice that I'm giving to my clients, and I do genuinely believe this is really good advice because some people have really benefited from this over the last few months, is that if you are going to be needing a mortgage in the next few months, while you have the option just to wait and see how things pan out in the short term, actually what I would really recommend you do is apply for a mortgage now and secure a rate. And if things do then turn downwards, what you can always do is ask that same lender to who may have reduced their pricing to move on to a lower rate before completion. Once you've completed, unfortunately, you're locked in, there's nothing you can do. But if their rates were to drop between application and completion, most lenders will let you move on to that lower interest rate, although they might charge you a very small administration fee for doing so. But by doing this, what you are doing is securing a rate now, so that if actually things go totally wrong for whatever reason and things shoot up again, you're not left high and dry. So we had clients who we spoke to, say 6 months ago, and we were saying to them, we think you should apply now. Actually, we think rates, while things are going downwards, it's better to secure things. And some people did that, and they're really glad that they did, because ultimately rates have gone up. There are other people who have said, no, I think rates are going to come down. I'm just going to wait and see what happens. And these guys have come unstuck. So I think actually at the moment, the best thing you can do for yourself is shore up your position, hedge yourself a little bit here, take a rate now, know that you can move things around later. Until you've completed, you're not beholden to anything. And then really just kind of secure your position. Anyway, that's all for me this week. If you have any questions, as always, we'd love to speak to you. 0345 345 6788. Have a wonderful week, and I'll catch you again same time next week.